We'll see what will be your questions, so do not hesitate to ask your questions, and Gavin will be here at the end of the session to respond. Now I give the platform to Gavin. Welcome and enjoy.
Thank you. So I should say a few words, Ivana, just to introduce myself, perhaps.
Yes, please.
Okay, hello everybody. Thank you very much for taking the time to listen to this webinar. I hope you will enjoy it. I've certainly put a lot of work in preparing it, and through discussions with people in the industry and other research. So I hope it's going to be interesting for you. So my name is Gavin Ryan. I was a private equity fund manager for 20 years. Before that, I was an investment banker in London at HSBC and Nomura for 10 years. And I started my work as a troubled company specialist at Price Waterhouse. The first fund I managed was a $30 million venture fund, part of Advent International. Then I went on to manage a $200 million regional growth fund, which was part of the Soros Group. And finally, I managed a 2.5 billion euro renewable energy fund out of Vienna. I now work in private equity in Europe, the Middle East, and Africa as a board member, consultant to private equity investors, management teams, and as a professional trainer, and working very closely with LEORON. So welcome everybody to my talk. I put up some slides, which I think you should be able to see. And so what I'd like to do is, before I launch into the presentation, and we'll be going into a little bit more detail in that, I would just like to say a few words about my take, my ideas about this crisis and about the private equity market. It's important to look at how private equity as an asset class has been affected by economic crisis. In the last 20 years, we have had three relevant economic crises. The first one was the internet bust of 2000. The second crisis was the financial crisis of 2009. And the third is the pandemic of 2020, right now. Let's look at how these affected the private equity markets. Of course, at the current time, which is April 2020, the pandemic crisis is still playing out, and so we do not have the benefit of hindsight. The internet crisis of 2000 was more of a blip for private equity. It was not so big. The market fell for a year or so, but then recovered strongly and grew very fast until 2009. A big feature of the market at that time was the abundance of inexperienced fund managers. One study I saw estimated that as many as 25% of the funds raised in that period were first-time funds. The financial crisis of 2009 was much more serious. The private equity market fell by 50% and subsequently reset from this lower level. Fund managers, many with a financial background, were poorly equipped to weather the new required focus on managing the portfolio. And this factor, coupled with the credit crunch, led to a significant slowdown and several managers exiting the market at that time in 2009. The industry faces the 2020 pandemic in a much stronger position than it did in 2009. Many managers who lived through 2009 are much more ready to take care of their portfolio companies. And the financial system is much stronger than it was in 2009. It's a big benefit that the last crisis was just 10 years ago, because many of the people who worked through it are still in the market and mostly in senior positions than before. And this is a valuable cohort of professionals for the private equity industry. Similarly to 2009, there will be a flight to quality, which will favor the more established fund managers for a while, and there will be a slowdown. But ultimately, the private equity asset class, unlike other asset classes, benefits from a long-term capital base and managers with deep experience and strong skills. And this will make all the difference. So we can ask ourselves, will there be opportunities for private equity as a result of the 2020 pandemic? Yes, and in a much bigger way than 2009. let's think about the differences. In 2009, there was a financial crisis which had an impact across all sectors of the economy, which eventually recovered. In 2020, we have a crisis that has caused complete disruption in consumer behavior. A short-term disruption we all know because we're living it personally in our homes, and a long-term disruption we still cannot be sure about. A global disruption in consumer behavior means a disruption that will be differentiated across sectors, which is a scenario completely different from 2009. In this sense, this will be a revolution. A new order is coming. Disruption means opportunity. We now need entrepreneurs who can spot the new opportunities that will emerge, and we need private equity fund managers who can talent scout these entrepreneurs and support them. Fund managers who will successfully play offense, not defense, in the new environment will become the new winners and top quartile fund managers. The others, the ones frozen with indecision, waiting, will fall by the wayside. So what the private equity industry is facing now is a huge opportunity which will come on stream eventually in 2021 or later, and the industry needs to get ready for the dust to settle and for the new order to emerge. So those are, in a nutshell, some of my general thoughts about it, and I think what is important is the perspective of comparing the current crisis to previous crisis, because we can have some lessons. And if there's one single important comment I can make about that, it's the fact that the last crisis was quite recent, and so many people who lived through that are still working in the industry today, and that is going to be very important. So let me turn to my slides. So we're going to cover in a bit more detail, and hopefully picking up some of the topics and concepts that I mentioned in my introduction. We're going to look at all the various aspects of private equity as outlined in the plan. So we're going to look at fundraising, deal making, some of the differences with the last time, and what will be the impact on both the LPs, the limited partners who invest in private equity funds, and on the GPs, the fund managers who manage those funds. So let's start with the macroeconomic picture. Now, I'm not an economist, I'm a fund manager, so I do not presume to have all the answers with regard to macroeconomics. I think that's not going to be an easy thing to do. I think if I had to say, make a few comments just in general about the macroeconomic crisis, I would say it's very different from 2009. Why? Because 2009 was a man-made crisis and it was a financial crisis. This crisis is not a financial crisis, it's an economic crisis which has reduced supply and demand simultaneously, and it's an act of God. It's not man-made, effectively. I would say that I have carefully looked at some of the economists' discussions about the effect of this crisis, and my only conclusion is that nobody can be really sure at the present time about what the effect will be. I've seen various economists estimate GDP decline rates ranging from nothing to minus 25% from Goldman Sachs. I saw that Deutsche Bank was forecasting UK GDP to be down minus 6.5%. So the fact that these forecasts are so variable means that, you know, it's people don't really know exactly what's going to happen, and so it should be. One thing we can do comparing to 2009 is that the financial system is much more resilient than it was in 2009, and also policymakers have learned a lot of lessons. What we're seeing now is a huge amount of public sector intervention into the economy, coupled with a good sense of on-the-ground success. So for an example of that would be Germany. The German government had a program to guarantee 80% of all loans to SMEs in the current period. They saw that it wasn't working so well with the banks. They increased that to 90% and then to 100%. So that gives me optimism because the governments are really trying to move as fast as they can. One thing I would say, looking at the different areas of the world, is that it seems at the moment that Europe is able to react somewhat better than the US economy, because Europe has the benefit of a welfare system, and that has allowed the European countries to keep people employed and have underemployment on the job subsidized rather than sudden unemployment, which is the case in the US, which is obviously much more difficult for people. So that's a slight difference between Europe and the US. What do we see? Depending on the scenarios, some economists are predicting it will take 2 years to get back to current GDP levels, but frankly, we don't know. Ultimately, until there's a vaccine, nothing can be certain. I think, well, if you see the slide, one thing you'll notice is the impact on sectors, and I think this is where the sudden shift in consumer behavior kicks in. You've probably seen many tables like this one I put up here on the slide. You see that obviously we have sector hits, so we'll have obvious negative impacts on travel, on hotel, on restaurants. We would obviously have surge in demand for food, pharmaceutical and online shopping. That's obviously quite predictable. What will be more interesting is if people will be able to predict the second order, the less obvious sectoral shifts, because that's where some of the opportunities will come from. We can obviously see the changes in consumer behavior, which we know from our own experience, the lockdown lifestyle, preservation of cash, privileging food and pharmaceutical purchases, and perhaps other indirect effects like an increase in online skills. For example, my parents are in their 80s and they have now become quite expert at online shopping, which wasn't the case before. Let me just say a few words about the private equity asset class. Getting on to private equity here. If we compare private equity to other asset classes, like hedge funds or other asset classes, private equity has some very good advantages. And one of these is the fact that private equity funds have a firm capital commitment. In other words, the LPs, the investors who commit to private equity funds, are committed for quite a long period. And that is a good thing, because if you're a hedge fund manager, your investors could be calling and saying, well, I want to liquidate my position, I want to get out, and your hedge fund could be collapsing as we speak. With private equity funds, that's not the case. I've heard of 2 LPs who've defaulted in Europe, and there've been a few rumors of a couple of others, but it's very small. And most LPs or investors in private equity funds are solid institutions like pension funds and insurance companies who do not make it a habit of defaulting. So private equity has firm capital behind it. The other thing private equity has is that private equity has time and patience. In other words, private equity investors are ready to ride out the cycle. They are not under pressure for short-term earnings, and that can only be an advantage in the current environment. The third thing, which is an advantage of the private equity asset class, is that private equity-backed companies are strong companies in general. If the company needs more money, it has a shareholder who is in a very good position to help out, whereas a quoted company or a family-backed company may have financial difficulties. So private equity-backed companies tend to be relatively stronger than other kinds of companies. And last, private equity has managerial resources. A well-run private equity firm has a strong management team with strong skills and experience, and some of those skills are quite relevant to managing the situation we have. So these are 4 big general advantages of the asset class, and that should not be ignored. And then finally, I suppose I could comment that in the current debacle and all the problems people are having, private equity fund managers get their salaries anyway because they're getting management fees, and that is something which is good for them. Obviously, doesn't affect everybody else, but that means at least they'll still be around to do their jobs. Let me say a few words about how the private equity asset class is performing. Now, clearly, it's going to suffer like many others. Let's look at a few studies, because at the moment we're only in April, and this crisis obviously hit us in January. But what could we say? Well, firstly, if we look at some parallels with 2009, we may be able to get some ideas. So firstly, if we look at the crisis of 2009, what happened there was that the average holding period of investments increased from 3.7 years to 6.2 years. That's what happened last time, 10 years ago. And we should expect something like that to happen now. In other words, the private equity funds will be holding on to their companies and their investments quite a lot longer than before. I don't know if it's going to go exactly the number of years that it was last time, but that's surely something like that is going to happen. What about valuations? Well, there have been different studies. One thing I could do is I could compare it to public markets. There was a study done by a limited partner of the pattern of crises between the years 1994 and the years 2019 using historic data. And what this study showed was that private equity valuation will usually follow the decline in public markets with a lag of about 1 quarter. So it will take about 1 quarter for private equity valuations to go down the same way as public equities. And the study also showed that the decline in private equity valuations was something between 50 to 55% of public equities. And then the recovery in the private equity market valuations was faster than public equities. So this study would suggest, looking at history, that the decline in private equity will lag public equities by 1/4. It will be about 1/2, and it will recover quickly, which is generally positive if we compare it to public equities. I've seen some other studies, a study by CEPRS, which was forecasting returns will fall by 10%. I've seen a study by MSCI, which estimated that the valuations of private equity portfolios were down about 30 to 35% compared to the end of December. But honestly, the studies are quite changing, and so we don't know exactly, but certainly the private equity market is going to be affected. One thing that's important to note is that the effect on funds will differ according to when the funds were formed. So for example, if a fund is a young fund, the fund was just set up in last year, well, these are very lucky guys because they've just set up their fund, they haven't spent any of the money yet. So they're in a fantastic position because they can now deploy this money at lower valuations, hopefully. Middle-aged funds which were set up in 2015-18 will suffer somewhat more, and the older funds will have big problems because they're coming to the end of their life and they're looking to make their exits, and the market is obviously collapsing, at least for a certain period. So the effect on valuations and on the performance of the asset class will depend on the fund vintage, but overall, what we should expect is that the decrease in valuation will be less, it will be attenuated compared to public equities, and it will not be realized because fund managers will hang on to their investments and wait to exit. So that's what we should probably expect when we are talking about the performance of the private equity asset class. Let me go on and talk a little bit about fundraising. Fundraising is a big part of private equity, and different studies have made different estimates, but quite a few funds completed fundraisings in 2019. So in 2019, the mega funds of over $5 billion accounted for about half of all fundraising, and the funds under $1 billion are at a kind of 15-year low. So the experience from last year was that the mega funds have increased their market share as far as fundraising goes. However, what should we expect for 2020? Well, we should expect a slowdown. A recent survey by the British Venture Capital Association showed a very large percentage of LPs who are planning to cancel their activity in 2020. So it's a little bit like a game of musical chairs. The music has just stopped, and if you are sitting down or if you raised your fund in 2019, you're okay. If not, you're not so okay. If we look at some examples, we could take a few examples. For example, Blackstone raised 26 billion in 2019, so they have plenty of money. I think other firms like Platinum Equity raised about 10 billion. I can't resist quoting the managing partner, Mark Burnhill, who was asked to comment about the crisis. He said, well, sometimes it's better to be lucky than good, because they just managed to raise 10 billion in January, just before everything happened. Ardian raised an $18 billion fund to do secondaries deals, and KKR raised 2.2 billion for their Japan 4 fund. So they got lucky. Others are less lucky. SoftBank has got some big problems. It looks like their second vision fund is probably going to be on hold, given the problems in Saudi Arabia, who is going to be one of the main investors. So fundraising in 2019 was big. It was a huge amount of fundraising, but it's effectively stopped. Fundraising has stopped. And what I expect is that there may be a certain amount of follow-on fundraising, but the absence, factors such as, for example, the absence of the possibility of a face-to-face meeting will favor LPs with GPs with existing relationships, because the investors will be more inclined to give money to people they know already, rather than have a teleconference with somebody they've only just met. So I think in 2020, the taps are going to be pretty much turned off. It's going to be much harder for mid-cap GPs to fundraise because of a flight to quality. And I think first-time funds, except for those with some compelling story or a unique niche, are pretty much out of the market. So a generic first-time fund, in 2020 is probably got very little chance. And so that's the picture of fundraising. It's pretty much stopped, but there's a lucky number of people who raised a large amount of money last year, and that money is there, ready to be deployed. And so that's really, I would say, the picture of fundraising. You know, as far as fundraising goes, it's not so great, but as far as investments go, which we'll see in a minute, it's not bad, because there is money there to be invested when the time comes. Let me talk now about deal making. Investments, the investment side of private equity. Well, we have a lot of what's called dry powder in private equity, which is there. And most of this dry powder is with the large buyout funds, because let me remind you that globally, it's estimated there's about between 7,000 and 8,000 private equity firms globally. And the vast majority of these firms, maybe 7,000 or 500 of them, are typically mid-cap firms. So a firm managing $100 to $500 million, employing 10 or 20 people. That's 90% of the GPs out there. And the mega firms only account for 10, 20, 100 firms. So that should always be borne in mind when we're thinking about the private equity market, because the large firms, the large deals attract most of the media attention. But by number of deals, the mid-cap market is where most of the deals get done. Now, it's been estimated that as of the end of 2019, we have between 1.5 trillion, which is an estimate by Preqin, and 2.5 trillion, which is a McKinsey estimate for the amount of capital which is potentially there. And so the deals are there. But what have we seen happen? We've seen no deals happen. There was a study that came out yesterday by CIL Management Consulting, who did a survey of GPs, and only 4% of GPs right now in this moment see the market as a buying opportunity. So everybody's kind of frozen, everybody's kind of on hold. Also because valuations are very, very unclear at the moment. Nobody really knows what the valuation is. And so if we look at what deals have been done recently, the only two major equity deals I saw was KKR, which bought a UK waste management company, Viridor, for 3.7 billion. And there was a deal by GSF, which bought Malaysia Airlines for 2.5 billion, backed by a Japanese private equity fund. And these were deals that were in the pipeline long before the crisis hit. What we've seen in terms of actual deals, which are a bit fresher, they've all been equity, they've all been debt deals. So we've seen BC Partners invest 400 million in a Dutch flour company. We've seen Canada Pension Plan lending 400 million to a Spanish company, Hotel Beds. We've seen Airbnb raise 1 billion from Silver Lake Partners, but also debt. Apollo Global Management is also planning to buy distressed debt. So what we've seen is debt deals, private equity fund managers not doing equity deals, but debt. And so what I'm expecting to happen during the course of the next few months is that any deals that will happen are going to be mostly debt deals, either the GP supporting their portfolio company by providing them with liquidity, or buying discounted debt from suffering companies or other fund managers or others. So the deals that we're going to see are going to be debt or quasi-debt deals, and very, very little equity deals. And as far as the mid-cap market goes, I talked to about 20 mid-cap GPs in the last 2 weeks. Everything is frozen. All the deals are frozen except for a very few that were really at an advanced stage. And the reason they're frozen is the valuation. Typically, when there is a crisis, and we saw that in 2009, what happened was that all the deals got frozen because the sellers were not ready to lower the prices. The buyers expected the prices to be lower, and there was a standoff between sellers on the one side and buyers on the other. And these typically take a few months to work out before one side eventually adjusts the pricing. So the mid-cap market is basically frozen because of no equilibrium on valuations. What I do expect to happen eventually is that the weaker mid-cap companies will be ready for a buy and build. So a mid-cap company backed by private equity will have an advantage of capital in terms of acquiring a competitor, which may be a family-owned company or another type of company with a weaker shareholder who may have eventual financial problems, which will force them to sell at a more discounted valuation. So what I'm expecting in terms of deal making is, in the mega deal side, it's going to be debt or quasi-debt, either supporting companies, and in the mid-cap side, it's going to be a frozen situation for a few more months, but eventually a kind of buy and build strategy, which may be slowly emerging, but it's nothing much will happen until after the summer. Of that I'm reasonably sure. Okay, so this slide just amplifies what I just said. So what we're going to look at, what you should expect, is buying debt to discount preferred type instruments. So we may see some quasi-equity type deals, but it's still too early. It's still too early to say. It's at the moment the market is really frozen. What about portfolio management? Now, what is going on as far as managing the portfolio? So now we're talking about private equity funds, existing investments, portfolio companies. And what's going on is several things. Firstly, there is a lot of analysis, and what a lot of the fund managers are doing now is that they are stress testing the portfolios. So what they're doing is they're running what if sales fall by 30%, what if sales falling by 50%. So they're running the scenarios to stress test and see which of their companies are the most vulnerable in the portfolio. Excuse me. What are fund managers doing as far as protecting the portfolio goes? Well, I think I don't want to go into too much detail. They're doing things that many people have talked about that you have to do with troubled company. I worked as a troubled company administrator for 5 years with bankrupt companies, so it sort of rings a bell. But the main things that people are doing is that they're looking at a series of interventions in their portfolio companies, which are going to be, firstly, staff protection, making sure that the employees are kind of okay and protected. Then managing liquidity, making sure there's enough cash. And then thirdly, supply chain and market impact. So looking at the supplier payments, customer receivables, and what the impact of the market is. So this is all ongoing. And what I've noticed is that some of the bigger mid-cap funds and bigger GPs have created in-house, some of them are described as SWAT teams or special teams. They've created some special teams to intervene where needed, and they've been boosting their operational support capability. What still hasn't really happened yet is any kind of restructuring. So we have to be clear that there's a big difference between operational support and restructuring, which are quite different things. So that's really what's going on in portfolio management. It's still early days, but the two things that are happening is the stress testing. Nobody's really trying to redo their forecasts yet because it's still too uncertain, and they've been securing the company's liquidity and making sure the companies have what they need to survive the next few months. What's also going on is some cash injections by GPs. So the GPs may be injecting some cash into their companies, or buying back some of the debt. One of the benefits of recent years, particularly the LBO sector, is that most of the debt finance that was raised in leveraged buyouts since about 2015 has been debt on what's called covenant-light terms. So the debt has been raised on terms with loan covenants which are quite weak or fairly flexible. So what I don't expect is that to be a lot of debt defaults, because of the covenant-light terms plus the realization in the market that these are extraordinary times is going to allow leverage companies to have a much easier time of it than they did in 2009. That is something that's absolutely for sure because of the light covenants. Where we are going to see a bloodbath potentially is in venture. In venture capital, where we're talking about startups and early stage companies, in the best of times, if I'm a venture capital fund and I have a portfolio of, say, 15 companies, I'm fully going to expect 3 or 4 of these to go bankrupt. I'm going to expect maybe 2 or 3 to really be a home run or do really well, and the others are going to be something in between. What I'm expecting in venture portfolios, so I'm not talking about growth and I'm not talking about buyouts, I'm talking about venture, is there's going to be a triage, to use the medical term. So venture capitalists are going to look at their portfolios quite ruthlessly and say, look, of these 10 companies, these 3 were kind of a bit weak. We were giving them a chance, but now we can't afford to keep any weaklings anymore. We have to kill it. So we should expect a triage or a killing off of a certain amount of startups and portfolio venture companies, which will be, have to be let go in a very unsentimental way in current times. So that's probably something that's very likely to happen. So that's probably the worst of the portfolio management that's going to happen. Let's go on to talk about a little bit about exits. Now, what's happening with exits? Well, it's a little bit the mirror image of deal making. Exits are pretty much frozen. Why? Is because with the current uncertainty, the strategic exits, so selling your company to a strategic buyer, most of the ones that are in advanced progress may end up getting done. I've heard some are getting renegotiated, but most are put on hold because the strategic buyers are waiting to see what happens for obvious reasons. And obviously all the IPOs are stopped because of the volatile stock market conditions. So exits are pretty much frozen and funds will wait. So what we're going to see is the average holding period that I referred to earlier is going to go up. So exits are pretty much stopped. The only thing we might see is where we have funds which are older funds, which are approaching the end of their lives and have to be liquidated. We might see some secondaries deals where they may try to set up new vehicles and try and roll over their companies into new vehicles or into another fund. But the normal commercial exit market is pretty much frozen, and that's probably going to be the case for at least the rest of this year. So exits, the only exits I can see continuing would be exits from one fund to another. So the sale from a private equity fund to another financial sponsor, they're more likely to be going ahead. But exits as a strategic to a strategic buyer or as an IPO or a stock market placement are pretty much stopped. Okay, let me give a few thoughts about what are the differences with 2009. I discussed it a bit earlier in my opening statement, but what are some of the key differences? They're all generally good for private equities. The first big difference is that in 2009, we didn't really have much as far as private credit funds. Now, this means banks, not banks, but funds who lend money as debt, senior debt or mezzanine or other types of debt. Now, this was hardly a feature. In 2009, it might have been 5 billion. Now it's about 30 to 35% of all private equity leveraged deals. The providers of debt finance are private credit funds. And these are going to be more flexible than banks because banks will obviously have a certain reaction. It's normal, they tend to be more conservative. And so the fact that we have private credit funds still in the market, and they're going to stay in the market, that's going to allow for more liquidity in the debt sector. So, you will have companies that will be able to raise money from private credit funds, perhaps teaming up with a private equity fund as well. And so that is something that was not there in 2009, which is there in 2020, and that's going to have the effect of increasing the liquidity of the market, and that's going to be a good thing for the private equity market. The second thing that we have is in 2009, many of the teams had no experience of crisis. I remember that very well because I was a fund manager at the time, and when we had the crisis, I kind of dusted off my hat as a bankruptcy administrator and sort of rolled up my sleeves and started working with the companies. I was on 2 occasions, I think I was interim CEO of a portfolio company. Now, most private equity fund managers in 2009 were really struggling with that. But now in 2020, we have a whole cohort and many people who've lived through 2009. Let's say we had a private equity fund manager who was something like a vice president in 2009. So let's say somebody in their early 30s or so. Today they're in their 40s, they're maybe a partner or a managing partner of a fund, and they lived through 2009 and the years subsequent to that. And that's a very invaluable skill. And one of the things that's important in private equity is that the turnover of the fund managers is much lower than in hedge funds or other types of funds. Private equity fund managers stick around for much longer. And so the collective memory is there. And that's going to be huge and a big asset compared to other asset classes. So that's something that's different today than in 2009, because in 2009, there were people who remember the crisis of 2000, but that was just a blip. And it wasn't such a bloodbath. And so people didn't have those scars which they can apply now today. The third thing that's different is that we've got much better communication between GPs and LPs, because when there's a problem, people get nervous about their money. And so the communication between the general partners, the fund managers and their investors, the LPs, is much, much superior today than it was 10 years ago. So they're proactively communicating with LPs. The fact that we have IPEV and ILPA reporting standards, which were introduced, is going to help a lot. So there's a lot more transparency and much better communication, which means LPs are going to be more willing to support GPs, if necessary, with more capital or as a co-investor or providing debt. So LPs are much more open and less nervous, let's say, than they would have been in 2009. And the last thing that we have that's different from 2009 is that the policymakers, the central banks, the governments are much more prepared than they were in 2009, and the reaction is much more solid. They're generally going to be able to make the economic environment better, rather than being confused as to what to do. Because I remember in 2009, the authorities were really struggling. Today, we can all see that. I'm not going to go into detail, but we can see that there's been a lot of very determined interventions, and that will help, shore up the economy, which is also good, obviously, for the private equity market. Let me discuss a little bit about what are going to be some of the specific impacts on LPs and GPs of this current pandemic. I think the impacts on LPs is most of them have suspended their commitments, except on an exceptional basis. In terms of their GP relationships, I think we're going to see a flight to quality. So LPs, particularly big LPs, a large LP like, say, Ontario Teachers or CalPERS or others, or EBRD or IFC, may have 100 GP relationships, maybe more. What we're going to see now is that they're going to be probably looking to concentrate their GP relationships on those GPs that are more solid and discarding the weaker or the more marginal ones. So we're going to see a flight to quality in the GP relationships. We see a need for good GP communication. If you don't call people, they get nervous. And we're also going to see a dynamic within LPs play itself out, because many of the investment officers in the LPs remember very well that if you invest in the bad years, when everybody else is panicking, that gives very good returns. And that was one of the lessons LPs have learned from 2009. And so many of the officers saying, well, this could be an opportunity. But on the other hand, on top of them, you've got their board and their trustees, who may be generally more cautious. So we have a dynamic of people knowing it's a good time to go in, but their boards or trustees urging them to be cautious, and that's going to play itself out throughout this year. What is going to be the impact on GPs, on the fund managers? I think, to give you an example, you say, okay, everybody's stuck at home, so guess what? Online commerce is going to go up. and home food deliveries are going to go up, and people are going to watch more Netflix. Well, my mother, who's 85, figured that out. So I don't need to pay a GP a salary to tell me that, right? So what we need to see is GPs who will play offense rather than defense. The GPs who can see beyond the first order impact and have a vision of what the longer term effect of this is, what sectors will do, are going to be those who are going to be successful. So offense means success, and that means seeing the second order impacts before everybody else. That's essential for a GP to succeed. And secondly, developing an investment strategy to capture that. So that's what we're going to look at as far as GPs, let's say, strategy development this year. The first-time funds are going to struggle because this is not a good environment for first-time funds, except for those who are uniquely differentiated in some way, or whether the team itself has a private equity track record they can look at. And GPs who have a track record which includes living through 2009 are going to be at a premium. Let me talk a little bit about emerging markets. I know that many of you are working in emerging markets. I certainly work a lot in the Middle East, North Africa and Sub-Saharan Africa. I have many friends and contacts there. I sit on a couple of boards there. What can we expect for emerging markets? I think it's not all good news. The flight to quality by LPs in developed markets, so the flight to quality by commercial LPs, is going to hit emerging markets. LPs are going to be retrenching to developed markets more, and so emerging markets will feel that impact. And so there's no sugarcoating that. That's going to happen. They are going to be pulling out. So kind of the Midwestern American pension fund is certainly going to reduce their commitment to emerging markets. There is an instinct, obviously, to go back to your home base, in a crisis. So that will happen. On the other hand, one of the characteristics of private equity emerging markets is the huge influence of developmental financial institutions such as the IFC, EBRD, the European Investment Fund, the African Development Bank, Islamic Development Bank, and some of the sovereign wealth funds who also like to support fund managers. And so what we should hope to see is some initiatives by some of the emerging markets LPs committed to emerging markets who may have either developmental agenda or who have a strong commitment to take initiatives to try and support the market, to kickstart the market, to step up and commit. Because as you know, many private equity funds raised in North Africa or in Eastern and Central Europe or in Sub-Saharan Africa will have some of the big developmental funds as anchor investors or as significant investors. So we have to hope and look for some initiatives by developmental GPs to make sure that the developed markets, the emerging markets, don't suffer. Another thing we are going to probably see is some differentiation, a bit of a shakeout within emerging markets between the solid and the weak. And probably what's going to determine the difference between the solid and the weak is going to be two factors. Firstly, the level of governance of the country, and secondly, the strength of the healthcare system of the country, which is clearly going to come into play as this pandemic continues. So we are going to see some differentiation, and people are probably going to be looking very closely at governance and at the solidity of healthcare systems. We've already had in the last few years a differentiation between frontier markets and emerging markets. So, South Africa is an emerging market, Burkina Faso is a frontier market, and other examples like that. Poland is an emerging market. I don't know, Tajikistan is a frontier market, and so on. So we've already had that, but that's going to get amplified further. I expect that in this year and next year. So that's my view of how emerging markets are going to play out. Just to give some conclusions, I think that we have pluses and minuses. So it's not all roses, but it's generally more positive than negative. I think the asset class of private equity is stronger than others because of the capital commitments, which is there, and because of the fund managers, even more so that we have the cohort of 2009 still firmly in place. There is going to be a premium on the experienced fund managers, and there is going to be a culling of first-time teams. Fundraising in 2020 is going to pause. Exits will be slowing down, and the portfolio holding time will hold. So there won't be any distressed sales, but the companies will be in the portfolio longer. Buyout funds, I'm sorry to hear it, but I'm a mid-cap guy myself, but the buyout funds are going to be relatively stronger than the mid-cap and the venture funds because they have more dry powder, and the LPs are more willing to back them. Emerging markets fundraising is probably going to pause unless the DFIs and the developmental LPs step in to be in a counter-cyclical move. And the people who are going to suffer the most is probably going to be the first-time funds and the weaker part of the venture portfolios. But the good news is, you know, let's all get ready for the new order that's going to emerge. I see the corona crisis not as something like 2009, where things are going to come back to where they were before. I see it more like the Second World War, where everything is being thrown up in the air, all the sectors are in the air, and we're going to see what's going to emerge, and we're going to see who's going to pick up the pieces and who's going to take that forwards. Okay, so that concludes my talk. Thank you very much for your attention. I hope you found it interesting. If everything goes back to normal, at least in terms of the lockdown, please do come, if you like, attend my course in London in August and in Dubai in November. And if you want to hear more about private equity, feel free to check out my dedicated YouTube channel, Private Equity Confidential. So I look forward to hearing your questions now.
Thank you, Gavin.
So Ivana, shall I just take the questions?
Yes, I believe you have access. So Shahzad Khan, and there is Mahmoud with several.
Okay, let me just look at some of the questions that are coming up.
Yes.
Okay, I have a question here. You mentioned in your introductions that entrepreneurs are required to take on opportunity. Is an entrepreneurship background required to be successful in the private equity class? Okay, well, I think I can answer this in two ways. Number one, you don't need to have an entrepreneur background to become an entrepreneur, because obviously you didn't come out of you were not born an entrepreneur. You can, there's no reason why, if you have a good idea, you have you have the belief, you have the passion, and you see an opportunity in all this crisis, there's no reason you cannot try and give it a shot. Okay, there's no guarantee of success, but that is the nature of being an entrepreneur. In order to succeed as a venture capital investor, so somebody backing entrepreneurs, many venture capital investors have been former entrepreneurs. So yes, in that sense, that can help, but it's not necessary to have been an entrepreneur in order to be a venture capitalist. I have a question here which says, regarding deal making, why would it be more debt deals than equity deals? Is this specific to crisis periods? Yes, in a way, yes, particularly now. And the reason for that is that nobody is sure about what the valuation is. So if you're not sure about what the valuation is, it's hard to make an equity investment because you don't know how much percentage of the company you need to own for your money. And so therefore, it tends to be easier to do a debt deal. And that's why we're seeing a lot more debt deals. Okay, let me look at some other. Okay, here I've got one. Dear Gavin, from your experience and background, how can we reform the regulatory and competitive environment in different industries that may shift? Well, I think as far as private equity goes, we're not going to need much new regulation. And the reason for that is that after 2009, there were a lot of problems in the private equity industry, particularly with the mega buyout funds. And what we saw happen there was some new regulations introduced, both in the US and the European Union, to regulate private equity fund managers, to increase transparency and to put some limits on the more risky activities. And these regulations are in place and they seem to work very well. So I do not expect new regulations to result from the COVID crisis as far as the private equity sector is concerned. Here's another question. With numerous scandals within Middle Eastern companies and fund managers like Abraj, what advice do you give to new fund managers when it comes to fundraising? Well, the good news is that private equity, Abraj was actually a real aberration. Abraj was a one-in-the-kind scandal because almost all the scandals involving fund managers involve hedge funds. And there's a very simple reason, is that if you are a hedge fund, basically, say you're a $100 million hedge fund, basically, you get $100 million in the bank and you start to invest it. And therefore, the temptation is there to misspend that money. If you're a private equity fund manager, you don't have any cash in the bank. You just draw down the money. The money's drawn down when you need it. And all the investments have a lot of due diligence and a lot of other people looking at the investment. So fraud and mismanagement is actually very rare in a private equity fund. And the only reason Abraj was able to do it was that they had different funds which they were moving money around. Abraj is definitely a freak event in the private equity sector. It's unfortunate because it did have an impact on the reputation of private equity in the Middle East, but it is a very unusual event in private equity. Here's another question. Why do you think Europe is dealing with the crisis better than the US? Well, I'm not an economic or political expert. I'm a fund manager, but I think one of the things I glean talking to economists is that because the Europeans have a stronger social welfare system, so a system of social protection is much stronger, they're able to use that system, mobilize that system better to protect people than the US. What we see in the US is just sudden unemployment. So I think that's probably one of the main reasons. Okay, I'm looking at some other questions. I have a lot of questions which are quite general about the economy. I'm flattered people will ask me about the economy, but if you could make your questions more specific to private equity, which is where I'm really an expert. Do you see, here's a question, from Adel Ansari, sorry I forgot to mention the names, from Adel Ansari, do you see the LP expectations of returns and gains being revised, and how can GPs convince them of the new realities? Yes, I think GPs are able to convince them of the new realities because the communication between GPs and LPs is very good, and that was one of the lessons of 2009. So most GPs, apart from the very small or disorganized ones, have excellent communication with their LPs. And so it should be much easier for GPs to convince LPs in 2020 than it was GPs to convince LPs in 2009. And I think the returns expectations of LPs will probably be revised downwards, but it's more the case that there'll be a delay. I think it's going to be more about delaying exits and returns than about fire or distressed sales. I have a question from Wael bin Siddiq. If I have private equity sector in healthcare, it will be high in 2020 and 2021. So I think the question is healthcare a good sector to bet on? Well, I think it's too early to say. I think healthcare has traditionally been a traditional defensive sector. So when things go bad, people still get sick and have to spend money on the doctor. So traditionally healthcare and food and education were traditionally defensive sectors. I think what's changed this time is the fact that people are locked up at home has changed things a bit. So for example, people don't go to the doctor so much, or they don't go to the dentist, or they don't do other type, or routine operations are postponed. So I think the effect on the healthcare is going to be more complicated than simply saying, well, it's a defensive sector, it's generally going to go up. I think we're going to have to look at the effect of the lockdown on healthcare. So it's going to be differentiated. Clearly, masks is going to be good, but other things like maybe dental work isn't because the dentists have stopped working. Okay, there's a question from Azam Haq. How do you see the private equity deal pipeline developing for the rest of 2020? I see the pipeline basically being frozen. In other words, the deals that are in the pipeline are going to stay in the pipeline and they're not going to become deals. So, you know, I think the communication between the GP and the potential entrepreneurs will stay there, but no deal is going to be done for a while because they may just agree to wait, or perhaps they might do some kind of deal like a risk sharing deal where you put the money in as a debt and you kind of value it later using some other mechanism perhaps. So there might be some complexity in deals, but there won't be any straightforward equity deals, I don't think, in the near few months. John Mubugua, thank you for your insights. Can we get access to your presentation? Yes, I think Ivana is going to make sure that you can get a copy of my slides. That's going to happen. What else? What other questions? Okay, here I have a question from interesting question from Ivana Lowe. I'm trying to choose people from Africa, Middle East, and Asia equally, and Europe equally. Ivana Lowe, dear Gavin, I'm a deal maker based in Asia. Given the possible reduction of globalization during the restriction of travel, do you think PE funds will still look at deal makers favorably by relying on origination? So is it possible to make deals with less travel? I think what's going to happen is a flight to quality. So what will happen is that a GP who has a trusted deal maker or intermediary they know for many years, who they know very well, they may be able to do a deal with them. The people who are going to have the problem are going to be the intermediaries who don't have strong long-term relations with GPs, who would need more of a face-to-face to persuade them. They're the ones who are going to be suffer. So there's going to be a flight to quality as far as intermediaries are concerned as well. Fahim Sonde, do you have a stress testing slide for private equity? I think what most private equity funds are doing is they're using a model, a financial model, and just simulating the effect of a sharp decline in sales and seeing, you know, looking at the fixed cost base and the unit cost to see if the company is able to weather it. So I think it's a question of looking at the different financial models of the different companies in the portfolio. Ingrid Schwank is asking, how would you assess mezzanine development? Well, I think mezzanine is going to be pretty good. I think this is a good window for mezzanine providers because a lot of the equity guys are going to be reluctant. And clearly, if you're a pure equity fund, you can't put all your money in as debt because you won't get the returns. So a mezzanine provider is in a very good position because you may have more flexibility than the bank in providing than providing senior debt, but you could structure something interesting because you could provide the debt, so you can provide the cash right away to the company, but you can have some equity upside. So I think this could be a very good window for mezzanine providers. Abdul Raf Haider, do you think it's the right time to take a long-term loan? Well, I think it's as good a time as any. I mean, I suppose as long as you're confident you can repay it, now is as good a time as any. Interest rates are quite low. Azam Haq is asking, is it safe? Is this a good time for vulture capitalists to step in to acquire distressed businesses? This is an interesting question. The question of vulture funds acquiring distressed businesses. I think this is a double-edged sword because I think what we're going to have is we are going to have distressed businesses, but we're also going to have people waiting. So people are going to try and hold out before selling. And so acquiring a distressed business, it may be the case, but we also have to be a little bit careful for some funds about reputational issues. It's one thing to acquire a small distressed company in Spain for 20 million euros. It's quite another thing to do a mega billion-dollar deal and acquire a distressed German company by an American buyout fund. That could have political pushback. And I think the industry, particularly the mega buyout funds, have learned their lesson from 2009, that they don't want to be seen as immoral predators because that may create a political backlash. So I think it's going to be a tricky area, the distressed deals, particularly on the big side. Okay, let's have a question from Sub-Saharan Africa. Frank Eddie Ozon. What do you think about the development of impact investing in areas like Sub-Saharan Africa? Well, I think impact investment is a lucky area because impact investment is an area which depends very much on developmental financial institutions, and in some way they are less commercial, although obviously we know impact is this kind of dual blended return. It's not one or the other. So I think impact investment may be one area which may be able to weather the storm a little bit better, because the investors in impact funds are very much have a mission to develop. So I think they will have an easier time than many others. Okay, Mohammed Riyad, how would you be able to compare the current economy with past pandemics? I think the question was, if I understand correctly, how could we compare the current pandemic with past pandemics, if I haven't misunderstood the question? Well, I think if you look a little bit about history, I would say I'm not a medical expert, so all I could really say is that the lessons of history definitely is that pandemics have a huge effect, and they do disrupt everything very, very big. And I looked a little bit about history. I'm a bit of a passionate amateur historian, and the two big pandemics in the past was the Justinian plague in the 6th century. This is in the year 550 approximately. And the effect of the Justinian plague, it led to the decline of the Byzantine Empire and of the Persian Empire, and it led to the emergence of the Caliphate. So one of the effects of the first Justinian plague was the emergence of the Caliphate. And then the second major plague we had was in the 14th century, which eventually led to the Renaissance. So these pandemics do have big effects. Clearly, those two that I just mentioned, they killed about 30 to 35% of the population, and clearly this isn't the case with this one, and we hope it's not going to be so serious. But let me get back to private equity, because I know more about private equity than I do about these other things. What advice, this is from Anne Ngugi, what advice would you give to an impact fund manager who is on the verge of signing an equity investment in a business, taking into account the impact of the pandemic on the valuation? Well, I would wait. I would either wait, or I would invest the money as a convertible loan. So put it in as a loan, and then have the conversion, the option to convert later. If you're going to put it in as equity, right, based on a valuation pre-pandemic, you might have a bad time. So I would try and maybe change the nature of your instrument.
We have Raja Al-Faleh.
Sorry?
We have Raja Al-Faleh with a question. A bit up.
Raja Al-Faleh.
Yes.
What if the equity is a service? Let's say technology service. What is the best tech to invest in? From Raja Al-Faleh, what is the best tech area to invest in? Well, as a fund manager, I'm depending on the entrepreneurs I invest in to tell me that, because if I knew that, I would be on a yacht, not doing webinars. This is a joke, of course. We don't know. Honestly, I don't know. It's still too early to say. You could say, obviously, e-commerce or home delivery, food deliveries. There's many ideas out there. Some may be right, some may be wrong. I don't know. The honest answer is, it's for sure things are going to change big time. The tech to invest in August of this year is going to be very different from January of this year, but I can't say exactly what that is. Mohammed Safil, what is a young fund, middle fund, or age fund? Okay, a young fund, what I mean by young fund is a fund that just got started, for example, in 2018 or 19. So the young fund has just started, so they have all their money, but they haven't yet started to invest, and that's a young fund. A middle-aged fund may be a fund that's from the year 2017 to 15. So let's say they're a €100 million fund. Maybe they've invested 50 million and they've got 50 left. That's a middle-aged fund. And an older fund is a fund, say, of 100 million that's made all their investments already and has no fresh money. So that's what I mean by young, middle-aged, and aged. Okay. Any other questions? Ivana, do you have any suggestions for other questions?
Well, here are some more questions coming.
No, there's plenty of questions. Some of them are not private equity related, and I'm not sure I'm enough of an expert to really
No worries.
answer them.
No worries. We'll
I'll do my best.
some which are left
Okay,
unanswered. We'll find a way to support
well,
everyone.
I have a question from Nader Hawass. What is the expected economic decline during 2020, and when is it expected to recover? Well, that's the big question. I don't think even economic experts know for sure. It's going to go down. A lot of economists are saying that if they they solve the pandemic this year, find the vaccine, it's going to be 2 years for recovery, so 2022. But you know, nobody's really sure right now, including the experts, and I'm not an expert on economics. Okay, I've Jimmy. Go ahead, Ivana. Can you suggest the question, perhaps?
Yes. Well, maybe some at the beginning, in case we missed.
I see one. Yes.
Yeah, if they just
Mohammed, go. Okay, I have one from Mohammed Kabani. What do you think about private equities which started to reduce their staff? How will it affect most sectors now all going remotely? Well, so far, I haven't seen much evidence of many private equity funds reducing their staff. And one of the reasons for that is that the salaries of private equity staff are paid by management fees, and management fees are paid by the LPs in the funds, and these are usually pretty solid institutions. There have been some rumors of some defaults, but generally there hasn't been a problem so far with fund managers collecting their management fees. So there shouldn't be a problem with them giving salaries to their staff. If there has been a reduction in staff, I think it's something fairly unusual. It's possible that the level of activity has gone down, so it's possible that some of them have gone, are working from home and so forth, like many other areas. And of course, a private equity management team, it's quite easy for them to work from home because you're not manufacturing, you know, it's basically people in an office. John Mbugua, do fund managers in Zimbabwe have an advantage in this pandemic? That's an interesting question. I honestly don't know. I'd love to know, but I don't see why a fund manager in Zimbabwe would have a specific advantage. No. Okay, I have a question from Abdel Chamad Mahamat. I apologize for my pronunciation. So it's Abdel Chamad Mahamat. Could you elaborate about the comparative appetite for private equity as an asset class in Africa relative to Europe? Well, clearly it's different. Africa is an emerging market, and we have to also segment Africa between North Africa, which is part of the Middle East, North Africa emerging market grouping, and Sub-Saharan Africa. And then Europe, we have Western developed Europe, and then we have Central and Eastern Europe. And clearly the size of the market is very different. One estimate that I saw by AVCA is that there's about 250 private equity firms in Africa compared to, say, maybe 3,000 private equity firms in Europe. So clearly Africa is an emerging market. It's at a much earlier stage. And then within Africa, we can divide Africa between North Africa, which connects to the Middle East, Western Africa, East Africa, and South Africa. So we've got these 4 distinct areas, but it certainly is an up-and-coming emerging market. Okay, let me here we have a technical question from Aziz Asmael. As IFRS standards, we have to follow cash basis and recording. So if somebody postpones an expense, this will give fake figures. So what do you suggest? Well, of course. Now it's quite normal. I worked for 5 years as a troubled company administrator many years ago, where I specialized in companies where fraud was involved. And clearly one of the things companies do to cook the books is they will postpone expenses, they will play around with accruals, they will change LIFO to FIFO, vice versa. And so all these things companies will do to pump up their expenses. And the way to solve that, what I suggest is you need to have a good accountant and to have some forensic accounting skills. Okay, John Mbugua. So do Zimbabwe fund managers have an advantage due to the constant instability? That's an interesting question. So John is saying, well, because Zimbabwe is so unstable, fund managers have are used to living with instability and have a more flexible mindset. Well, that could work. That could well be the case. Yes, there is that difference. You know, today we have a lot of uncertainty. So yes, maybe there is an advantage in that sense. Yes, you're right. Okay, Martin Frost. How do companies from emerging markets prepare to survive? And how do first-time fund managers learn quickly from the present situation and present quality? So how can first-time fund managers learn and present enough quality to LPs to maintain confidence and traction? Well, in private equity, the real way you learn is from experience. So the best way that first-time fund managers can learn quickly is to do lots of deals, roll up their sleeves, and deliver the results, and try and get their experience accelerated, because what will convince LPs is experience. Azam Haq, in the light of the current situation, do you see cross-border private equity funds becoming more selective about their investment geographies? Definitely, I think people are going to focus where they feel more comfortable. And if somebody's doing an area, a geography, which is for them more experimental or adventurous, now is not going to be the time. So you should expect that, absolutely. Ali Al-Mualad, why is private equity better prepared for a downturn than a decade ago? Well, a decade ago, the fund managers were not prepared for tough times. Today, the fund managers, many of them have lived through 2009, so they're better prepared because they have the experience from 10 years ago. In 2009, they did not have experience from a tough time before that. So that's the reason they're better prepared. Okay, Hatim G. So from Hatim G, as an LP, what private equity criteria should I consider in this crisis to invest in a private equity? What are the thresholds? So so what criteria would be, the number one criteria would be, has the fund manager, has the team lived through the 2009 crisis, and do they have evidence to show that they did good work in the 2009 crisis? If they can show that, that's a gold star for them. Okay, Ingrid Schwank, another question from Ingrid Schwank. I think it's her second question. Could state financing in companies be a competition for private equity funds in the mid-cap market? So in other words, if the company can get state financing, can that crowd out the private equity fund? Probably not, because the state financing is most likely going to be some form of a loan, and private equity could be complementary, for example, by putting in, you know, the company could raise a certain amount of money from a state loan, and the private equity fund could put in a tranche as maybe preferred loan or a mezzanine loan or preferred equity. So I think the private equity fund could work with it and to do a package. So I think it could actually help to increase the volume of deals rather than the opposite. Okay, Yahia Salem, question from Yahia Salem. What is the difference between financial crisis and economic crisis? Well, that's easy. In 2009, it was a financial crisis. So we had a problem of the financial system, a collapse in the banking system, a collapse of liquidity. What we have today is we don't have a financial crisis. Today, the banks are fine. There is liquidity. What we have is an economic crisis because we have a sudden, complete change in demand. By virtue of the fact that everybody's locked in at home, the patterns of demand have completely changed, and that's an economic crisis. What we may see in a few months is we may start to see a liquidity crisis. If people have to stay at home and don't work, like the self-employed, after a few months, they might start to run out of money. You know, if people are living on their savings, so that we might start to see that. But I don't think that's yet going to happen. It's probably a few months away. So Raja Al-Faleh saying, but the economic crisis will lead to a financial crisis. Yes, if it lasts too long and people run out of money, yes, it will. But I think people are going to do, the governments are going to do everything they can to try and change that. For example, in Austria, Vienna, where I'm based at the moment, the government has announced that in a week or so, they're going to be lifting some of the lockdown restrictions. And they're hoping that by middle of May, that restaurants will be opening again, for example. So we have to wait and see. In the next few weeks, things are going to be much clearer. Nader Hawass, is asking, concerning obtaining funds, what do you recommend? If you have money, keep it saved or buy a property? Well, I would probably keep it saved and wait for the property market to fall, because normally, like many asset markets, the people, you know, let's say I'm trying to buy, if I'm interested in buying an apartment in Dubai, the chances are it's going to be a few months before the developers start to lower their prices. They're probably hanging on, you know, trying to keep the prices up. So I'd wait. Okay, this is an interesting question. Mohammed Ilyas Ali is asking, how is the current crisis going to affect the people mentally? Well, clearly this links to the points I made about consumer behavior changing. We all know the short-term change in consumer behavior because we're all at home. So we know it's about watching Netflix, it's about you know, home deliveries, it's about using the internet more. We all know that, we're all doing it. How is it going to change longer term? Well, I think nobody really knows. If you know the answer to that question, you could be a successful entrepreneur. You know, one thing people were saying, for example, is that more people are learning how to use the internet to communicate. For example, my mother and father, who are 80, are now very good with Zoom, very good with e-commerce, very good with Amazon online. So we may expect a permanent increase in the penetration of internet ability, which will have an effect on the consumer market going forwards. Other things we may see is, you know, I don't know, some people were saying people now discover home cooking, so people will cook at home more because they've learned to cook. Other people are saying as soon as the lockdown is finished, people are going to go crazy and all go out. So who knows? It's difficult to be sure. Okay, Ingrid Schwank is saying, sorry, I meant states buying into companies in the form of equity shareholders. Okay, so if governments, I think it's unlikely that governments will do equity. They usually do debt or some sort of soft loan. What I could see happening is if the governments are buying into companies in terms of equity stakes, when things pass, the governments want to get rid of those stakes. So that may be an opportunity for fund managers to buy out those government stakes, you know, when the time comes. Okay, here's an interesting one. Azam Haq, Saudi Arabia and other GCC countries are going to slow down in the current pandemic. Do you think the governments will be willing to take a haircut on valuation to keep the privatizations active, or are they going to postpone privatizations? Normally, privatizations involves lots of politics, and so governments tend to be very slow to take a haircut on privatizations unless the governments really need that money for the budget. Now, I think in the case of Saudi Arabia and others, countries such as GCC countries are pretty rich. They have quite a lot of money in sovereign wealth funds and other places, so they don't need the money for the budget. The only place where I noticed that happen was Eastern Europe, where Eastern European governments had already put in their budgets the proceeds from privatization, and so they had to sell to get the money. I don't think that's going to be so much the case in the Gulf, because they can afford to wait a bit more. Let me see. I've got quite a few questions on general economic things, which I'm not sure I'm qualified to answer. Okay, Mohammed Al-Shami is asking, how can you positively manage equity after the crisis, as the effect was not just economic? Well, this is where being a private equity fund manager is give you an advantage. Managing equity proactively requires skills, and that's what private equity managers have or should have. Clearly, there will be some fund managers who won't live up to that and may not have the skills, but there is a good number of them. There was one study I saw which showed that in the year 2000, there was only 1,500 experienced fund managers in the whole world. So think of that. In the year 2000, there's 1,500 fund managers who are experienced, meaning have had 7 years experience or more. By the year 2014, this study showed 6,000 fund managers. So by 2020, we probably have about 10 or 12,000 experienced fund managers in the whole world. So there is a shortage of supply, but we hope that they will be enough to keep things going. Okay, here's a question from John Mbugua. Thank you, John, for your numerous questions. Do GPs that are not fully invested look at their investment strategy and wait for the dust to settle? Are we entering into a new normal? I think yes. Generally, the GPs who are not fully invested should wait. They should not invest. The dust has not yet settled. We're in the middle of a dust cloud, and we are going to be entering into a new normal, a new order, but not for a few more months. Okay. While bin Siddiq is saying, after the corona crisis, will we see high prices in the private sector to compensate for losses? Well, I don't know. I don't think so, because it depends on demand. You know, people say, well, I lost a lot of money, so I'll put my prices up now and to make up for what I lost. Well, you know, people don't have the spending power. That's simply not going to happen in a functioning market economy. So unless you have a monopoly of some kind, I think that's going to be difficult. Okay. Here's a question from Jimmy Lapotulu. Jimmy Lapotulu. Okay, sorry about that. Should an equity fund manager wait for the pandemic curve to flatten before investing big? How liquid is the market? Well, the market is liquid for the big buyout funds. There's about $2 trillion of dry powder out there. Definitely have to wait for the curve to flatten, and a few months after that, I would say. John Mubugua, would you advise for sector-specific funds to be open to other sectors? I think that's a difficult one, because firstly, you have to get the investors in your fund to agree to that you want to change the strategy. And secondly, does the management team have the track record or experience to cover that new sector? If they don't, then it's a problem. Okay. Ivana, do you have any questions you think I should respond to that I've missed?
I don't think so, but
okay.
Even if we miss anything, just to let everyone know that there will be an opportunity to watch a recorded session of the webinar, and we'll still be connected, so they can either come to your training or they can get in touch with us to communicate on anything further.
Okay.
So
okay. I have a comment from Abdullah Khan. He thinks the world has more appreciation of internet and online, and so he's expecting more ideas and initiatives for online in the future, including cybersecurity. Yes, absolutely, I agree. Of course, we have to see, you know, just doing online isn't a guarantee of success, but in general, yes, I would certainly agree with your sentiments. Okay, so I apologize, I haven't answered all the questions. Some of them are more generally about the economy, and I don't always feel I have the expertise. There was a question about what about oil prices and gas. I don't know, I'm not enough of an expert. Mohammed Asim, can we invest in medical supplies and face masks and sanitizers to get a profit? Well, if you have a factory that makes them, well, that's great. If you're hoping to trade them, well, you might have an issue with supply, but certainly if you are the owner of a factory that's making those, you're in a very good position, I'm sure. Let me see what else. Okay, I think yes, okay, Mohammed was on the lighter side, absolutely. Somebody asked me about Bitcoins. Mohammed Ilyas, what about Bitcoins? Well, honestly, I think Bitcoins were a speculation even in good times. Nowadays, honestly, I honestly don't know. I own some Bitcoins. I made money, but it was pure luck. I'm a valuation expert. I mean, private equity fund managers are pretty good at valuation. and I don't know how to value Bitcoins, honestly.
Well, so far there, okay, some questions are coming.
Okay, there's a question from Mohammed Asim again. What about investing in gold? Yeah, well, traditionally investing in gold was when people are, living in turbulent times. Historically, gold was always something that people would invest in. This has been as long as, ever since the days of, the first city in Mesopotamia, Uruk. And so, absolutely, yeah, gold is always a refuge. Okay.
Well, if anyone has...
Okay, well, the questions seem to have slowed down. I'm still ready. If somebody has any last questions, thank you. A few of you have sent me some compliments about the session. Thank you very much. Azhar, what's up, Azhar? Thank you.
I do get a lot of emails as well asking about the recorded session, so hopefully by tomorrow everyone should receive it.
Abdullah Khan, thank you all. Welcome, Abdullah. Thank you for joining.
Thank you, Abdullah.
Thank you, Nasa Hawass. What's up, Nasa? Thank you for your thank you. Thanks, Mohammed Danish. Thanks, Mohammed Ilyas. Thanks, Azza. Thanks, Mohammed Asim.
I'm glad you enjoyed.
Thanks, Mohammed Al Shami. Thanks, Abdul Ruaf Haider. Thanks, Reem Ahmed. Thank you, everybody.
Well, most of you know with the
thanks, Adele. Thanks, Azam. Thank you very much.
Yes, thank you, everyone. So we can maybe step to closure of the session. Lastly, what I would like everyone to know is that we've been transitioning from the on-site to online. Now the opportunity to have the trainer without traveling, without being mixed with other people, except just being comfortable at home. We are organizing a lot of live virtual training programs, and for those interested to see Gavin again, we have him planned on August and November. However, with the crisis happening, we will be able to open a session even sooner. So we'll agree on Gavin's availability and we can plan something again. The session is called Certificate in Private Equity, which not only seeing Gavin, hearing his experience and having his knowledge, to the opportunity to hear him out and also become certified. I'll be sharing more details after the webinar. So that will be all for now. Thank you again. I think it was a wonderful opportunity to have you, Gavin. So thank you especially for being so helpful and open and providing great time to everyone. I believe everyone enjoyed the presentation. Was amazing. Even for myself, that I'm not directly involved in equities, but I was pretty curious to hear an opinion from expert in your field. So thank you again, and have a lovely afternoon. We'll keep in touch. If possible, we'll try to be more helpful and arrange more of these informative webinars. So I believe it's a great benefit for all of us.
Thank you very much, everybody. Thank you. See you soon. Thank you. Bye-bye.
Thank you. Thank you, everyone. Bye-bye.